Allow me to start by doing a very short introduction on Peter. We have known each other for several years, and in one of my very first official functions in Moody's, I led a delegation that met him and other members of the board in the old headquarters of the ECB. But our relationship in a lateral fashion goes much further back than that. Years ago, Peter was the chief economist of Fortis, a bank that no longer existed but was my first bank in Belgium. And he was also a professor at University de Bruxelles, where I was a visiting fellow in the ACARES, the research center of the UAT. So our paths laterally crossed during many different stages before our current position. Peter is a member of the executive board of the European Central Bank. He is its chief economist, and without further ado, I will let Peter start his 30 to 40 minutes speech with us. Peter, the floor is yours.
Thank you. I'm filmed, no? For makeup. Good morning, I guess. Yeah, good morning, good afternoon. Adam, you remember? It was in December. I don't have much to add to what I said at that time. It was right, you say? I don't know, but it was. So I was preparing here a few minutes this my intervention. I was wondering, do I really repeat exactly what I said in December? And you take me at that time, you know, so first, what I said actually, that was this discussion about what we call the sense of urgency. We had a sense of urgency in an acute financial crisis, of course, in 12. It was one example, you know, whatever it takes of Mario. It was the sense of urgency under severe financial stress conditions. But then by, I would say, mid the summer of 14, and I refer, for example, the speech of Mario in Jackson Hole, was another sort of sense of urgency, which is not under severe financial conditions, but the same sense of urgency related to the fact that the euro area, in particular, was entering in a risky situation, which is a sort of downward revision of long-term growth expectations and also inflation expectations. It's a sort of downward revision of nominal growth, I would say. And of course we said, permanent income, but also the inflation expectations, risk of the anchor. You know that central banks usually talk about risk of the anchoring of inflation expectations, but there is another risk which is parallel to that one, and they both interact, of course, is the anchoring of longer-term growth expectations, this permanent income story. And the two interact, of course, because nominal growth matters, especially if it follows, expansion, credit boom, and nominal growth matters, of course. And in recent speeches, I see some who heard it already, I showed the evolution of nominal GDP in different places. US, for example, in the euro area, the nominal, and there is a growing gap between what is in the US and euro in nominal terms, and also in real terms, of course. And 3/4 about this gap, 3/4 is real, and 1/4 is inflation, basically. But accumulation over the years, about 7 years now, is worrisome. That was why we as a central bank gave a number of signals about what I call the sense of urgency to act. And we have said at the same time that one needed, in that situation of the risk, and I think it's more than a risk, some materialization of downward revision of both long-term growth expectation and inflation, all the responsible authorities had to act And I say we didn't use coordinated way. It's each authority has to take its own responsibility and not waiting for the others to act, or taking the excuse that the others are acting so that you yourself not act. So each authority in its mandate has to act. But of course, each authority, I mean we in particular, have to say to the other authorities, if we do something and you don't act, it's not the end of the story is not going to be very nice. So in that sense, you inform the others about your own action, how you see the situation. You need we never called it a coordinated response. We said a comprehensive policy answers to that situation. We strongly believe that. So it is, what do you mean with authorities? Well, we mean plenty of authorities. And I will give you a few examples which are not sufficiently debated in the media, I would say. Very much in the Peterson Institute, very much in institutions like Moody's, which I will say no, so that you know what it is. It's work-out scheme. Obviously, if you have a lot of non-performing loans and legacies of the debt, it is very important that we develop the institutions that would facilitate a workout process of debt. And I have a list here to prepare here, but we will not have time, fortunately, because it's complicated. Patrick, you know, because we discussed yesterday about this. And I went through, this is just an example about what we mean when we need a comprehensive policy response. Well, I just give an example. It's also lawyers that help, you know, revamping and improving insolvency law in more coordinated way in Europe, but also the facilitating private sector work out, informed, out of court settlements. We know that, of course. And when we say why the growth performance was so weak in Europe, because there was a credit boom and bust in the US, there was a credit boom in some of the European countries. Why this difference? There are many reasons for that, but one of the reasons is that we don't have good institutions facilitating the exit from excessive debt. And just to tell you that in that sense we need a policy response. It's not a question of saying monetary policy has to be more accommodative, fiscal policy has to do more, we need structural reforms on the product market and the labor market, and etc., etc. We all need a little bit to reflect on all that. But there is more than that even. And I think it's on the positive side, the signal I wanted to give here, especially in the context of Peterson Institute, because very often you came with that argument, and you in your business, you of course are very much interested in workout procedures in institutions. I think it is very interesting when you go through the different countries, which we are on the stress Ireland with Patrick here, but we looked at Slovenia, we look at not always good examples, but the efforts of societies to go into that. We have an issue with Cyprus. One of the reasons we have some difficulties in closing the program with Cyprus has to do with these issues. The rest seems to be on track. And then discussions, because these are difficult discussions in societies, because you deal with property rights, redistribution of property rights when tensions between creditor and debtors. I will not enter the question of sovereigns here in that discussion, but you're aware also that there are discussions about sovereigns, what happens. And it's also a debate, obviously, that we have in our societies. So here I looked, and I will be in Portugal next Monday. That's one of the things I would like also to understand better. I mentioned Ireland, I mentioned Slovenia, I mentioned Italy, where, as you know, there are discussions going on about facilitating the workout of non-performing loans which are on the balance sheets of the banks. I wanted to take 5 minutes to say that, because I think it should come more as a headline. Because as you know, when we talk about QE, we talk about buying assets on the market, having via portfolio rebalancing effect, low interest rates, or lower spreads, so compression of spreads or rates via the portfolio rebalancing effect. It is quite important when we talk about what sort of assets, will this portfolio rebalancing go? And there's a question about corporate bonds being, even in negative territory, for some of the top names in private sector. There is also a gisement of credit risk portfolios which are on balance sheets of institutions and which should be out of these institutions. And our society has to facilitate, the institutional framework has to facilitate that transfer of assets to other investors. In that context, that's what I wanted to add in this discussion today, in a context where the Central Bank for Monetary Policy reason does increase its money base by buying assets with the intention of producing portfolio rebalancing effect, because that's a transmission channel. And then people say, there are not enough assets, what are you going to do? This portfolio rebalance, are they going to go in US assets and other assets that will create an exchange rate transmission channel, and actually will create problems here on currencies and all that? I think let's not forget the other part of the channel, which is the credit portfolio, which is also one of the things. So that we have to organize it. When we go with the ABS initiative, you bought a lousy 2 billion, people say, a little bit more than that. And people ironically say, But I can tell you this is something very serious, which has to be put in this context. It's not because we want to be the main driving forces of that. That's not our role. But also we are very, as a monetary policy authority, dealing with transmission mechanism problems by the banking sector, the lack of capital market union in the EU. So for us, we have an interest, a vested interest, a stake in the development of institutions that would facilitate what we call the transmission of monetary policy. And in difficult times where we have a lot of heterogeneity, portfolio rebalancing effect, creditor-debtors problem, the role of institutions facilitate that is very high. And our ABS is not a question only on volume of liquidity that you inject. We don't have done that, of course. But it's also, as a side effect, facilitating, because we have standards, facilitating also indirectly, as I said, because that's not the objective, but facilitating also, it's an externality, I could call it, facilitating also the development of an institutional framework which would facilitate the transmission of monetary policy. Because it's not our task, of course, to create capital markets, of course, in Europe, but our actions obviously have an impact on the way markets function. So to put it very, very clearly. So that's, a first message. The second, when we go into the decision making, what I said before. So we have 7 years. We have this risk for me. Some call it secular stagnation, whatever the name, but it is a risk that we have because 7 years is a long period of disappointments and expectations. And at some points, you can say markets were too optimistic before, so productivity was already slowing down before, so there's a bubble, so it corrects, okay, fine. The other is, which is also true, is the longer the period of low growth, the worse potential output in the future, because what we call hysteresis effects, what we can call the hysteresis trap, because the longer. And so that's something at some point you have to address, you have to stop that. And because if you don't do that, and some of you may say we are already there, or we are entering that, so each of us will have a judgment, but the signal we gave at that time was it's right time to intervene on both, because I talked about the nominal, that is the real, and the price also, which is our primary responsibility on our side. And that also explains why we wanted comprehensive, but also we have to take our responsibility as a central bank. So this situation can lead, and maybe we are already in that situation, which I illustrate usually by looking at capacity utilization as declared by business. They are not that depressed compared to the estimates we have on the output gap, the macro estimates of output gap. This is typically what we call underemployment equilibrium, because at the micro level, societies, companies, business may say, I'm satisfied. My machines are there for an expected demand in the next 5 years of 0.51% in the next year, so my capacity is all right. I don't make very much profit, it's fine, it's okay. But you are in an environment of slack around that. And I don't know if you have noticed in the introductory statement, when Mario, the last one, read it, there is indeed a reference to the slack. We have in recent times a number of positive news, really, in terms of flows, a number of positive news. You can say these are green shoots, it's modest and all that, but they are a little bit everywhere. I can give you the list. It's still something interesting to say, and we have the oil prices, of course, we will not forget that. But you see a little bit of these things emerging everywhere. And so you have to say, yes, this is in a context still of slack, massive slack in the Eurozone as a whole. So we should not only look at the flows and the deltas, but also of the stock effect, including, as I said, the stock, like the legacy of the debt, the unemployment, of course, some of the sector which still have to restructure and all that. So let's not forget the stock and not only look at the flows. The flows look good, I must say, much better. Now, so so from that situation, not to be too long, and then let's see the questions. So the action that we had in January. First point I hear. The first question is there a need to act? So that brings us, somewhere in January. Is there a need to act? And in the governing council, of course, there are different views on that. Some people say let's wait a little bit more so we get more information. We have a positive shock on the economy, so there will be positive news. That's a little bit my flow view. At the same time, in the negative, we had inflation figures where, on the negative side, we had a repetition again of disappointments on the inflation path. We were continuously surprised on the down compared to what we expected. So every month we have some short-term projections, updating our projections, given the inflows of oil prices, currencies, tax changes, things like this. So we update our models continuously, and continuously we had an undershooting. Of course, it was oil and energy, it was oil, it was food, but it was also the core inflation that started to be more and more hit. And we also saw there was more transmission from headline inflation to the core inflation. And then we have various, Patrick, very detailed. We follow that in very much details. I can give you a few examples. We look at the proportions of prices falling, for example, in individual countries. Of course, we look at inflation for the euro area, but we also want to see if some of the countries which are more depressed than others, if we see signs of deflation in these countries. A sort of, I don't like to say it, but quote in terms as a good experimentation to see what happens there. And it is true that when we say about stickiness, of services, for example, it's not always true. You see that also some prices can fall also in core inflation, in the more resilient part of core inflation. Now, of course, you can say that's part of the adjustment, the internal devaluation. Yes, it's absolutely true. At the same time, you cannot neglect the fact that prices can be downwards, they can go downwards. And of course, we look at the euro area as a whole. But we look at this process of deflationary process, how they can emerge in some of the countries where the growth rate is the weakest. And we see in some countries, and a few countries I could mention that, but you see, for example, proportion of prices falling, headline in the HICP core, proportion of prices falling, and the evolution of that in some of the stressed economies, or economies which, like Spain, I would say, are distressed or not. They're emerging from a big stress, but their proportion of prices falling is not trivial, it's not small, and rising. So these are things you cannot neglect. We look, of course, at Europe area as a whole. So the question of risk of the anchoring of inflation expectation is something that we took into consideration, of course, very seriously within our mandate in the governing council. And is there a need to wait a little bit more, or do you have to act? It's very much debated. We decided to act in January. Second point, of course, is the zero lower bound. And as you remember, we have a zero lower bound. We even have negative deposit facility, minus 20 basis points. And that we also had the forward guidance in July 1 year before, and before 14. And so what do you do in these circumstances with zero lower bound? So we go into asset purchases. We started first with the credit easing, because that's where we saw that market, the most impairments in the transmission were in the credit markets, and we tried with the measures. And we said very clearly that we would act as a result of two considerations. We would look if the measures we have taken between June and September would work or not, would disappoint or not. It was relatively easy. And we will update, our inflation projections and look at the situation of price stability in the medium term. You have noticed that sometimes when we say inflation, price pressures are going to remain weak for an extended period of time, we tended to say price in the medium term, we said in the medium to long term. So you can see we stopped also since sometimes to say inflation expectations are solidly anchored, because that's the mantra of central banks. We say they are solidly anchored. You have noticed over the time that that message has been more careful, right? I think, because you cannot deny that there are risks to that. And so we announced that the first point was the measures we have taken, and the second was our assessment of the situation. And sometimes we say, you acted because if you hadn't acted, the markets would have corrected very much, so you are captive of the markets. And you do it because if you don't do it, then you get a correction. I think totally different. I think what we really communicated, as I do now, we communicated our reaction function very transparently. And of course, markets do the same as we do. They look at income information, they have their own views on what will be the future income information, and they take positions at that point. And then, of course, when you act, markets will not move a lot. There was a little bit of surprise, I admit. But markets, and then say, it doesn't work because prices have not really moved very much. No, it was already anticipated because they believed your reaction function and you acted according to what you said you would do under these circumstances. And then we are not captive of the market. We just say this is our analysis, this is the view we work, this is our reaction function, and people in markets can do their work, can be mistakes or not mistakes, but that's what happened. So we have this. Now the question about the instrument, now on credit easing first. The credit easing, and that's part of the good news that I was mentioning before. And first, on the credit easing, we have been positively surprised, and I think we published yesterday information about interest rate, this loan rates, and interest rate conditions paid by borrowers and all that. Published that yesterday. We have positive surprises since September. We have seen that since September, the loan rates have really in stress countries. We look bank per bank. We look at banks. We have information anonymized by banks, and we look at lending conditions, and we look at prices when they lend, how much we pay to loans to SMEs and all that. And then we have seen surprises in stress countries has fallen much more than we were expected. What we do usually is we look at the MRO, the base monetary policy interest rates. We classify the banks, in different places, stress, non-stress, basically. And then you see the gap, you lower the rates and you say the stress comes, nothing happened. And then it started to fall as it did in the non-stress countries. So we see on the price effect, we saw on the price effect that what we decided, you cannot say it didn't work, it worked. But not sufficiently, because when we looked at the volumes, and that's why I talk about the ABS, volumes could be higher, but there are a lot of considerations, as I said, around the ABS market. On covered bonds, if you buy 10 billion per month, you multiply for the time being. The program is according to our expectations on the covered bond market. We'll see what happens later. But on the volume, obviously, on the TLTRO, we have been disappointed by the volumes. Of course, market said, we told you, it's a little bit in between because it's on the left side of our range. It's a little bit in between, but it is true that on the volume it disappointed. And then I refer to a reaction fund. We say as a result of these measures, TLTRO and the others, our balance sheet, the increase of the balance sheet will be sizable, and then we gave some indication what do we mean with sizable. And then coherent with our reaction function announced, we said, well, we don't get the figures right, and we have to come up with measures, new measures, to fill what was not happening. And then also to update to measures given the new context that we got. And then we came with these decisions. Now when you go into QE and you buy government bonds, of course there's not much to buy. That's why I refer to the importance of institutions and work out, because there are many other things where a sort of QE, if that would exist, would be much more efficient than buying government bonds and much less ambiguous. When in a Eurozone you buy government bonds, in a Eurozone which is absolutely specific, because we have a treaty which protects the central banks from fiscal dominance, we are not in a fiscal union, and so this is a very sui generis, it's a very specific context in which you are. So when people start to write on loss sharing, no loss sharing, I think, as you know, you have to, somewhere here, you have really to take into account the fact that it's not that's something in a monetary union without a fiscal union. When you start buying government bonds on the sovereign market, there is an ambiguity always, and the debate is absolutely normal. Some will say this is a transfer union from the back door. The other would say if you don't buy that, if you don't utilize the losses, then you signal that that country or is not, that sovereign bond is not a good risk. So of course we had to take that into consideration. What was important, I always said, we argued on this, we always said what is important for a central bank is the monetary policy decision. If you think you need to increase base money or the liquidity, have you the capacity to decide in a complicated governing council with a number of members there, more countries, members there around the tables, and can you agree in that committee? We did agree. And other consideration may interfere with that decision, and markets are looking at the cohesion of the group. Are you able to decide? And if you can, it was demonstrated that you have the capacity, as we had always in the past, to decide when we considered that time was right to decide. Now it is true, also true. I mean, it is true that when you have to qualify the QE, and I go into something that has been a bit more difficult, is you go into the instruments now, the choice of the instruments, as I said. You go for QE, you buy government bonds. I say the loss sharing interferes quickly in the discussion, but when you buy there, the question is it really an instrument of monetary policy? Yes, it is, and it is unanimously recognized. So I think it's important, it's been communicated, it is an instrument. Where the differences come, as I explained already in December, the difference come, some would always say, for good reasons, I mean, it's debatable, it's very sound to have that in a committee, to have people with different views. One view would say, let's wait a little bit more for information, and some will say, no, it's time to act now. That's a normal and it's a good debate. The other debate is a bit more complicated. It has to do with what I would call a non-linearity in the instruments. So you cannot end up in situation to say, if we lower the rate, if we had interest rate margin, which I said already in December, if we had interest rate margins, we would probably all agree to lower the rates. But we have to shift to another instrument. And before we shift to the other instrument, we really need to have very severe conditions because then you have a vacuum in your instruments. Because when you see zero, there is nothing in that reasoning, there is nothing before you go into very severe conditions, which were assessed by some as not yet the case. And then how you say exactly what would be these more, so we say these instruments are really in extreme situations. So it's public information, I say, it's not. If we go into this extreme situation, given the situation that we have today already, then you would conclude that this extreme situation would mean that inflation expectations are de-anchored when you use that instrument. So you would use that instrument only if you see inflation, which we don't see now. But then, of course, you would say that if you use these instruments when inflation expectations are de-anchored, then it becomes very difficult, as you know, to get out of that situation. And so that's the sort of discussion which is very delicate, because it's a question which has to do, if I have interest rate, well, maybe we act, but we don't have room, and before we use the next instrument, really the situation has to get much more severe than what it is now. So that's just leave it to your reflection about. So we decided to act. I talked about the portfolio rebalancing, and let me say so you know, you discussed that this morning, the signaling, the rebalancing, and let me talk a little bit about the green shoots, or about the sort of information we have. First on oil. One of the arguments, you have a positive supply shock. Of course, in the beginning was demand supply, the most recent is supply. So why would you act when you have a positive supply shock? And then the initial conditions are important, of course, because if you have positive supply shock and you are in a fragile inflation expectation environment where the inflation expectations are at risk, let's say, of being anchored, you have to be very serious, because you will get negative figures, and we have negative figures. Probably most of this year will be negative. on end inflation with the present oil prices and the currency will be negative. So you have to be very careful as a central bank, because we missed, close to 2% over a number of relative low long period in the past, but also in the expectation. So this process of de-anchoring of inflation is something that you cannot take with benign neglect, even if you have a positive supply shock. I said in Peterson Institute, we can't take the luxury of just wait to see. So we have to think carefully. And then we had this conclusion, we took that decision. Now this decision being taken, which I think will contribute, I think so, to the re-anchoring of inflation expectations, then you do the maximum with your oil price shock. So we have the oil price shock, which is positive, but it is really positive if your inflation expectations are anchored. If they are not anchored, you lose a lot of the impact. Think about my very first point at all. So it's not inflation not sufficient. I mean the other leg has to work too. We have financial conditions I mentioned before, and we have on fiscal policy, as you know, it's more neutral. We will not talk about the Commission communication recently, and then we have the structural reforms I mentioned a little bit before. Don't underestimate that. We see some very positive effects in countries, but you have a positive contribution a little bit here and there, which are being put in place. There's a lot that remains under time pressure, but a lot that remains to be done. But I think we have now a combination of factors which I think will be translated and visible in growth figures. Inflation takes a little bit longer, as I told you, but that's a little bit the story where we are. So now it's being implemented. We haven't issued yet the technical details of the QE, so there are a number of questions there. We are finalizing because we have to write it right legally when we come, as you know, in the market. So we know what we want to do, but we have to write it legally. Some of the points are not yet fully in the market, but basically we communicated most of the points, the questions which we got on this. You asked me to stop. No, that's fine. Thank you, Richard.
I'm extremely sorry for having interrupted so rudely Peter, given the fascinating insight that he provides to us on the thinking of the European Central Bank. But we do have to allow time for you, the audience, to address questions. So we now have roughly 20 minutes left for the session. I would like to open it for questions for participants of the audience. Same rules as before. Please raise your hand, wait until the roving microphone has reached you, and when it reaches, please identify yourself and your institution. Please allow me to call for questions from the audience. The gentleman there has the first question, please. Peter, you are free to reply from the table if this is more comfortable for you.
I thought you were saying I'm free not to reply.
Well, you are free not to reply either.
I think you're right. I'm interested by the questions in any case.
Matthias, I have a question on the criticism that has been raised against QE. Say the Bundesbank, which has been very concerned about moral hazard implications, and then related to comments by the Greek finance minister now, because people have made the point that it's not clear whether the debt of some Eurozone member states is indeed sustainable, but yet the ECB bought some of that debt as part of the S&P program and is now embarking on further purchases as part of QE for obviously for different reasons, but is again buying those bonds. And then
those bonds. What do you mean? Those
some government bonds within the euro area. So and then over the last couple of days, the new Greek finance minister has come out and said Trichet was I don't recollect the exact words, was a fool to buy those bonds, the Greek government bonds in the first place. Does that criticism now change your thinking on QE and how you're going to proceed on Greece? I was just interested in your thoughts on that.
We have a number of criteria under QE. We explained that. I mean, long, so I don't understand exactly what is your question actually. One of the question is the moral hazard. By buying, you may reduce the incentive of governments, to act and things like this because there is a buyer on the market somewhere. So that's one of, I guess that's one of the
maybe just to clarify, so someone could say, I don't know, a finance minister of another country could say 5 years.
We are recording, we don't need to have...
Just to clarify, the question comes across that a finance minister of another country could say in 5 years, it's foolish for the ECB to take this decision this time.
I don't even listen. I mean, really, frankly, I mean, I'm a central banker. I mean, if I would listen to all what politicians say, they say many different things, and then they evolve, they change. No, really, I'm not kidding. I worked 1 year in Ministry of Finance, I know how it works. And, I'm really, it's very serious, actually. I think it's not the question you have behind, and in the question agrees underlying your question. I think it is true that you like to see a little bit clarification, because it's true. I mean, I don't deny, I read the newspapers, but you see there is a lot of talk, but which you have to take with some distance, and you have to see really what will be the program of the government. And as you know, there have been contacts to understand better. I think that has been very fruitful, has been said. I think it is true. And that it's fruitful, it's understanding. It is not an easy situation. When we decided on the waiver, we have the rules are known. I mentioned before our reaction function in monetary policy. Here the rules have been very clear on the waiver, so it should not be as a surprise. We said here it's currently not possible to assume a successful conclusion of the program review. For technical reasons, it was until end of February, because there was also a political environment, but there was a negotiation going on with a credible perspective of finalizing it at the end of February. We have a new situation here, which we fully respect, a new situation, fully respect. We want to listen, because there is, as you alluded, a lot of noise, a lot of speech, which we understand in pre- and post-electoral periods. So I think we have to take it, as I said, a bit, with distance. I mean, I don't really listen, I want to see what is the communication at some point, what is really the intention. That's the first point. And I say that sort of dialogue is something which is absolutely indispensable. And I must tell you, it's really interesting in a good sense. I mean, it's something where you learn. It's really important to listen. It's also very important to communicate what can, what cannot. And in that sort of dialogue, you say, look, we are a central bank. In this question of waiver, this is the rule we have. Everybody knows this rule. You need to have a credible perspective. If you go, you accept as collateral bonds below investment grades. You need to have a credible perspective that efforts will be made to regain investment grade status. And that's a very flexible, actually, attitude. When you do that, it's quite, in a way, risky as a central bank, but you take that responsibility. Now, when the environment changes, and there is some understanding of that, but you need this credible perspective of concluding, so that the sustainability, of course, of public debt will be there, of course. But you will not take each word, that you hear in the press, in the corridors and all that at stake. You need, but at the same time you have your rule. But whatever you do, if you postpone the waiver, all these decisions will be interpreted in a certain way. Here we say we have rules which are clear. We need to have a credible perspective about what is the program of this government. At the same time, people say, "Wow, you're in a fragile financial situation, so it's risky." We, in our communique, as you know, the banks are counterparties in our monetary policy operation. I think this has not been sufficiently commented. They are counterparties. Of course, when you lift the waiver, there will be lesser counterparty in volumes, because a lot of bonds, government guaranteed bonds that they pledge, to get central bank liquidity will not be there because of the lifting of the waiver. They have the emergency liquidity assistance, which is the central bank of Greece. It doesn't change in terms of loss sharing a lot, because when you put with the waiver, in the present in the balance sheet of your system, the losses are carried by the national central bank if losses would happen. So it is in the common framework when you have the collateral with a waiver, the loss system is the national central bank. So even when you go to ELA, it doesn't change. It doesn't change the situation. But there is an ELA, there is a procedure where we, because you provide ELA only for solvent banks, so you have reports. You want to understand, what is the evolution of the system, what is the environment of the system, and all that. So liquidity is provided, and so there is a shift from the balance sheet of your system to the balance sheet of the central bank of Greece. And so there are counterparties, but they don't have all the collateral they can pledge at the ECB. So they will go under ELA for that part which is not anymore under the rating waiver. And this is, so I think it's, we have seen that, as we say, suspension has no impact on the counterparty status of Greek financial institutions, which is quite an important signal. Liquidity needs can be satisfied by the relevant national central bank, in line, of course, with Eurosystem rules, as you know the rules. And we also said that the waiver, the suspension is in line with the rule, since it's currently not possible to assume successful conclusion of program review, and then we will see what the signals are coming. When because I know there are a lot of questions on this, so I speak very, very openly here. It is very important to listen on both sides, and I read the newspaper, by the way, that I listen. But I'm not an influencer, I just want to see. I see in the words, because you mentioned one part, but there's another part which is also communicated, which is, for example, things which are in the program and have not been implemented by the present program, where we have issues, Europe has issues, because parts of the programs were not or partly or difficultly implemented. I talk about the tax administration, for example. Tax collection, for example. So there are rooms, I think, where things are really can be the matter of fruitful dialogue, and I think it's something as I feel it.
Indeed, I think that now we have margin for another question. The gentleman here. Same rule as before. Please try to be short.
Some people, especially in this country, believe that the emergency liquidity is also open to abuse, and that it sometimes can be used to indirectly fund the Greek government. How do you respond to that criticism, and is there any need for perhaps a limit on that?
I would hope that the next question is more QE related than the Greek one.
He is right. There is in emergency liquidity, there are two issues, in recent years. I'm not going to be too specific, but in emergency liquidity, there are two specific. One is because ELA, emergency liquidity assistance, is short-term, it's for solvent institutions. So that's the rule, and against adequate collateral, may not be liquid collateral, of course, but mostly in these situations, but against collateral. The problem in which we have been in since 2008-9, and even more in 10-12, that period, is, as I said in the right beginning, as a result of a big deficiency of resolution institutions dealing with banking crisis. Because you cannot ignore, but we cannot ignore the institutional environment when you have a shock as we had, where you have an entire banking system that were at risk of collapsing. Really, this is really a situation that happened. And you say, and then you discover, I knew it before, because I very often, before the crisis, that's one of the things which I witnesses worked on the institutions dealing with banking resolution, which always amazed me how weak they are and where. It's not only Lehman, it's at the national level, even for relatively classical institutions. So when the crisis comes, your interpretation of ELA has to take that into account, which leads to very difficult discussions, of course. And when you have the link between the banks, there is no backstop. The state itself in a difficult position. that's what you refer to, that sort of situation. And it's absolutely right. I mean, it's a real situation where I lived all these very difficult decisions that we had to take. And you cannot take one view of this. The question, of course, is how you get out of this and preserve and rebuild in a way where it will not happen again. But I mean, where the incentives will be preserved. And here, in what you mentioned here, I will not go more into the details. But it's true that when you provide liquidity, there is quickly, what do you do with that liquidity that you receive from the central bank against what sort of collateral you receive? So do you have from the back door a monetary finance of fiscal deficit via monetary policy operations or via ELA? That's something we watch. And you know a little bit what I'm referring to. So that's part because we clarified our ELA framework also in that respect.
Indeed, again, as I stressed, please a non-Greek question. The lady over there.
Thank you. Yes, I have a technical question about inflation targeting. Don't mind, nothing to do with Greece.
We don't target. We don't target inflation. No, we don't inflation target. You know that, huh?
The European Central Bank is
No.
an inflation targeting central bank.
No.
Would you have this formally?
Yeah, sorry. Yeah, okay.
No.
Let me carry on.
Go on, please. They're not inflation target. Yeah.
Would you like to answer your question? Why are you not an inflation target? Okay, all right. So it's to do with the ECB's policy reaction function and its inflation risk sensitivity. If I understood correctly, there were two major parts of your speech today that related to inflation influencing dynamics within the Eurozone. One is to do with stock, the other one with flow. You used words like slack and trap with respect to the former. You used the words green shoots with respect to the latter. So it seemed that the ECB needed to see deflation risks rising to be able to justify quantitative easing.
Yes, I would say yes.
Thanks to that flow, and thanks to the momentum of improving impulses from growth figures, the turnaround in oil prices, weaker euro, other bits and pieces going on, it is possible that that we can argue that the deflation risks are now being much better managed than they were, let's say, at the beginning of January.
Yes, I know what you're going to say, but yes, I follow you fully. Yes.
So while the momentum has been managed, the stock problem is still there. There's still slack. So I think the ECB has done a fantastic job.
You're welcome to.
If you don't mind, I would rather let you do that. So the deflation risk has been managed. What about inflation target now? Are we going to get a 2% in the medium term?
Are we going to reach our
And assuming that is the end of the question, so that we
Forgive
don't
me, yes.
go
No, sorry, the end of the question is, are we going to get more QE, do you think?
That's the question. Good.
No, I think you phrase it very well, I must say, except the target. And click on the web of the ECB, you will see a lot of discussions about are we targeting or not, because the targeters are no flexible targets, and we are not targeting. Some people say, well, there are elements of targeting. The question is very often linked, you are the master of all these discussions. And so here we usually, when you have targeting, very quickly you have a sort of reference to a date, 2 years, 3 years, something like this. We don't have that, and that we have in the medium term, which creates some ambiguity, which is some of the criticism we get. On the other hand, we look at the origin of the shocks, because inflation, even for a prolonged period of time, can be weak or high. And you have to observe, things like sudden round effect, indirect effect, direct effect, and that means of the origin of the shock. You cannot say, it's 2 years, I need this, and you can say it's 2 years, and then you have to write a letter to, let's say, to the chancellor, or because you have not. We are in the other. Both are not comfortable, obviously, but we think it's also in our strategy not appropriate to say it is this. What counts, of course, in the end is this concept of anchoring of expectations and how do you measure that and all that. And it's not easy. When I think I showed, which is, don't trap me in the 5 years in 5 years or market expectations. We know that the price is a mix, of different moments of the statistical distribution. So we have to be careful of all these indicators. But one of the things I very often look among plenty of indicators, so don't trap me in one indicator, but plenty, as you know, Patrick, is a price of protection against deflation. Really, deflation. In the next 5 years, you buy contract 5 years, how much do you pay? And of course, it's not liquid markets. I know that distribution of risk may change. But still, I mean, if you look at that's interesting because you had a number of spikes which always related to a crisis, a financial crisis, sovereign or a financial crisis, a Lehman crisis. But now it goes up and it's in quite time. It's not crisis time. It is a deeper concern somewhere that people are more ready to pay a higher price, not for inflation, but for deflation. So a number of indicators that we put together. Now, of course, when you look at survey of professional forecasters, they will say 5 years in 5 years, they almost don't move. They're still relatively close to 2% on the long term for the forecasters. Now, when you ask them why, you know what is the answer? They know that the central banks will do what is necessary to reach the close to 2%. That's part of the credibility, of course. But still, I mean, it relies on the trust they have, which is a good sign. But it's also said that they lose trust, then you can also revise that. Now, we can continue to discuss, but it is true that the risk has been increasing. It is true that supply shock explains, of course, a lot of this weak inflation. But don't forget, before the supply shock, we had weak price pressure extending into the medium term. Weak price pressure extending into the medium to long term. And then you question the target, you say, yes, okay, I understand it's not 2 years, it's a bit more complicated. But when you reach that, and when you say, well, they're solidly anchored, so then you say they are anchored. And then you stop talking about anchored, you say they're at risk at. So there have been a lot of signals of concern of the ECB, and I think our policy has been consistent with that. But we had to face, as you know, a very complicated situation of heterogeneity, so it has not been easy, obviously. And so it's still difficult, of course it's difficult. But the green shoots are there.
So are we going to get the 2% over the medium term?
In the medium to long term, yes.
That was a very clear and short reply. We have time for one single last question. Brief, short.
Brief.
That was implicit on the message.
So, Francesco Badia, this is something of a follow-up to what we just heard. I mean, in the morning, Mr. Rosengren told us that one lesson from QE in the United States is that it's much better to have a state contingent rather than a time contingent, an open program, and rather than a time defined. So you chose a quasi-open program.
Hybrid, I would say. Yes.
If I understand. But then there is another issue. In the case of the United States, the link was to a very precise level of a very precise variable, unemployment. In your announcement, there is a link to inflation, but it's much softer than just saying we want to achieve this in that time period.
Yes.
Can you tell us a little more about your choice of not going for something more precise?
No.
No,
but I mean, it's of course you imagine. I mean, as an economist, I thought about different formulations, and you're quickly trapped also in a different formulation, which you would say, look, I would say in the US not has been easy with coming with quantitative. So it is true that it's judgment. It's more judgmental that as we didn't quantify and say it's this for the last 6 months and the next 2 years or something like we have a compact of 10 indicators or 20 indicators that we try in a mysterious way to combine and to reach a conclusion that we reach or not reach, or we are likely, because we talk of the path, we have to see that the path is improving. It's 19 months from March. It's a period, and there will be a lot of events there. So it's very difficult also now to see 19 months. I think what is important at this stage is a signal. We had exactly, you remember, also with you, exactly the same sort of questions on the forward guidance. There was the same question we had on the forward guidance. And we had different central banks. One came with a very quite complicated forward guidance, very comprehensive, very well constructed, but complicated. We had a qualitative sort of forward guidance. I think it helped because I remember it came, at a time where we had a divergence of the start of a divergence of monetary policy between the US and we because our EONIA curves or money market curves were quite closely related at that time. The US was building up. We were, under the risk as in emerging markets at that time, and others being aspirated, by that. The forward guidance, you could say, well, that's not the reasons why. You could de-anchor, decouple from the US. You could say it's not the forward guidance, it's luck or it's other things, but we wanted to have that and we had it. So you could say, discuss and argue, but that's what we got. We wanted that, that's what we got. So is it forward guidance? I think it contributed because we signaled very often the divergence of the path of monetary policy, and we communicated our assessments, and we did what if our assessment was confirmed by the facts, then we decided to act. And we could find in the Governing Council also very strong support for what we did. Patrick, you can testify.
Peter, I would like to personally thank you for the wonderful discussion that we just had. I would like to invite all the audience to follow me